The strengthening of the rupiah against the US dollar can be attributed to various factors. And the key factor is the return of foreign capital inflow to Indonesia, particularly in the bond and stock market. The situation is driven by global monetary policies, especially in the United States in 2024. The Federal Reserve began slowing down interest rate hikes, promoting investors to seek higher yield in emerging markets such as Indonesia. Moreover, Indonesia's recent foreign exchange reserve has strengthened the rupiah. Higher reserve provide a buffer against currency volatility and allowing Indonesia to intervene in the foreign exchange market if necessary. Stable macroeconomic conditions, including positive economic growth and controlled inflation, also support the rupiah appreciations. To explain the rupiah strengthenings, we can refer to purchasing power parity theory. According to this theory, the exchange rates between two currencies will fluctuate in accordance with exchange in the relative price of goods between those two countries. If price in Indonesia remains stable or lower compared to US, the rupiah is expected to strengthen. Indonesia inflation stability, as seen in recent times, aligns with this theory. Additionally, this fiscal effect is relevant in explaining the relationship between nominal interest rates and exchange rates. This fiscal effect suggests that difference in nominal interest rate between two countries will be reflected in their exchange rate movements. When nominal interest rates in the US are lower, investors tend to shift capital to countries offering higher return, including Indonesia, which subsequently strengthened the rupiah. However, the theory should be understood within a broader context, acknowledging that exchange rates and influence not only by economic factors but also by market sentiment and global political conditions. Political stability in Indonesia and investor confidence in the country's economic policies also play a significant role in boosting the rupiah. The strengthening of the rupiah has both positive and negative effects on Indonesia's economy. On the positive side, a strong rupiah reduces the cost of imports. The price of import goods, particularly capital goods and raw materials, become cheaper, which promotes production efficiency and lower costs for domestic industries. A strong rupiah also benefits the government by lowering the value of foreign debt repayment in rupiah terms. However, there are negative consequences, particularly for the export sector. With a strong currency, Indonesian products become relatively more expensive in international market, which might reduce the competitiveness they pose as challenge for industries that rely heavily on global markets, such as textile, rubber, and mining. The tourism sector might also be affected as Indonesia becomes a more expensive destination for foreign tourism. Monetarist economists like Milton Friedman offer valuable insight into understanding currency fluctuations. Friedman argued that the monetary policies and inflation stability are essential for maintaining a strong and stable currency. From a monetarist perspective, exchange rate change reflect the fundamental economic conditions of a country, including inflation and economic growth. Monetary policy can ensure price stability domestically. The currency should remain strong in this long run. In Indonesia's case, Bank Indonesia has implemented disciplined monetary policies, maintaining interest rates at a level that are competitive enough to curb inflation without excessively burdening economic growth. This aligns with Friedman's view that monetary stability will support long-term currency strength. From a personal standpoint, I see strengthening of the rupiah against the US dollar as a double-edged sword. On the one hand, it reflects global market confidence in Indonesia's economic fundamentals, such as stable growth and controlled inflation. The strengthening of the currency also directly benefits industry that rely on imports, particularly by lowering the cost of capital goods and raw materials. On the other hand, I believe we must be cautious to ensure that its appreciation does not erode Indonesia's exports competitiveness. Indonesia's economy relies heavily on export-oriented sectors such as palm oil, coal, and manufacturing. If the rupiah becomes too strong, Indonesia's product might lose the competitive edge in the global market, which could ultimately affect our trade balance. Furthermore, I think that Indonesia should continue to strike a balance between monetary policies that support price stability and exchange rate stability while also fostering economic growth. Exchange rate fluctuations, whether too strong or too weak, can have negative repercussions on various sectors of the economy. In conclusion, the strengthening of the rupiah against the US dollar is a complex phenomenon driven by various global and domestic economic factors. In theory, this appreciation can be explained through the purchasing power parity and Fisher effect, which highlight how inflation and interest rate impact exchange rates. From a policy perspective, Bank Indonesia must continue playing its role in maintaining exchange rate stability without undermining export competitiveness or economic growth. From my personal viewpoint, it is essential for Indonesia not to solely focus on currency appreciation as a measure of economic success, but also to consider its impact on sectors sensitive to exchange rate changes. Balance is key where domestic economic stability must remain a priority among global dynamics. Thus, the strengthening of the rupiah is a reflection of Indonesian economic present, but it also demands conscious policies to ensure its benefit are broadly felt across all sectors of the economy.